Hello, I'm Brian Lucarelli, Director of our Private Client Services Group and co-chair of our Family Offices team at Foley & Lardner. And today I'm here with a couple of previous presenters, Jason Cahoot, a partner and also a co-chair of our Family Offices team with me, and Stephanie Dirksen, an associate attorney. Both are members of our Estates and Trust Practice Group. Welcome back to both of you. Today we're going to discuss income and estate tax planning that business lawyers should consider before the sale of a client's business. But before we get started, would you mind each sharing just a little bit of your professional background with our audience, and then we'll jump right into it.
Sure. So as Brian mentioned, I'm Stephanie Dirks. I'm an attorney in our Estates and Trust Practice Group. A lot of my practice focuses on clients with closely held businesses and working on business succession planning and wealth transfer planning for families.
Hi, my name is Jason Cahoot. I'm an attorney here in the Milwaukee office. I work with a variety of clients, but a significant amount of my clients are people who've owned closely held businesses or who have owned closely held businesses and have sold or transitioned out of them. And then we do, for those clients, a number of different things, but a significant part of it is tax mitigation planning.
Perfect. Well, I've got clearly the right two presenters on this topic today, so why don't we jump right into it? And we'll start out with, so what are some tax saving strategies business lawyers should consider for clients from a pre-sale perspective?
Yeah, so there are lots of different tax saving strategies business lawyers and also owners of closely held businesses should consider before they sell their business. We'll start off with some income tax considerations. So, are there ways to save on income tax? For instance, that could be state income tax. Is there a way for the business owner to save on state income tax, particularly if they are in a high income tax state? One instance could be, could they transfer some of those interests to a family member who lives in a state that has lower income, state income tax? Could there be a way to transfer some of that to a trust and have that trust be a resident of a state with a lower income tax? And this is going to depend on where the business owner lives and on their family situation and, on who they want to be trustee of the trust. So there's a lot of different factors here. But in certain situations, we are able to help decrease that burden of state income tax upon the sale of the business, where the business owner might be subject to a significant amount of gains on that sale of the business. So just thinking through, are there ways where we can decrease that state income tax burden? Another thing to think through would be, does the stock qualify as qualified small business stock, QSBS stock under Section 1202? And under that section, you're allowed to take a certain amount of exemption from capital gains tax. And so you really want to think through, if this works for the business owner. Again, we need to look at their particular situation. But if they are able to qualify under that, exemption, what we can do is maximize that exemption and have multiple taxpayers take that exemption potentially. Again, it's going to depend on the situation. But one instance would be, could we transfer that to a family member, to a trust, and really maximize that exemption from gain and really create multiple different exemptions? There's a few different things we can think through there. And again, this is going to be for business owners who, maybe had this founder stock at the beginning of the company took off, the stock is really valuable now. And again, how are we going to, can we utilize the Section 1202 provisions to really take advantage of decreasing that income tax burden for the business owner?
Well, those are certainly some interesting strategies to consider. Are there any special considerations for real estate?
Yes, Brian. So Stephanie just talked about the one type of client, our tech entrepreneur client with QSBS stock. We have a lot of that in our Utah offices. Here in Milwaukee, we work with a lot of people who have manufacturing firms and are, actually do own real estate or other assets as part of the business. One thing that we've explored with clients and we've actually focused on as part of the M&A process is, if the business or the business owner, the business owner's family has the opportunity to retain real estate, perhaps it's subject to a lease as part of the sale. If they're able to retain that real estate, they don't have to have a taxable gain on that real estate, and they could use that to enter into what's called an exchange fund or 1031 exchange, which would allow them two key advantages. One would be they don't have to pay income tax on that portion of the sale that's attributable to that real estate. Secondly, because that the real estate was never sold. So there's no gain on that real estate. And then secondly, if you're able to transition this into an exchange fund, 721 fund, or 1031, you may end up with a really nice investment assets that's well diversified. It's not going to be dependent on what happens with the building into the future, with that particular building into the future, but you may be able to move to something that's much more advantageous or diversified, like apartment complexes or residential real estate, or a big diverse batch of real estate.
Well, thank you. And then how about gift and estate planning considerations?
Yeah, so far we've kind of focused on income and capital gain savings, but there are a lot of estate tax planning that we can do as well, and a lot of savings we can achieve. You have to remember the federal estate tax. Basically, if your estate currently is over 13.61 million, the federal estate tax is going to tax all assets over that amount at 40%. Also, some states also have a state estate tax as well. So you can really be subject to a large portion of estate tax depending on the size of your estate. Also remember that as of right now, law could change, but in 2026, the exemption amount is going to be decreased. So that's, estates that are over, let's say 6-7 million, anything over that is going to be subject to that federal estate tax at 40%. So if you're thinking of selling a business, and this is really particular, this strategy really works well if it's a few years before the sale. So, if you're thinking about this and you're going to sell tomorrow, this strategy probably won't work. But if you're going to, think you're going to sell in a few years, some things you can really consider is, maybe making a transfer of some of that business interest to a family member, or maybe to a trust for a family member. And we can, we recommend doing this before the sale because we can take a valuation discount on the transfer of that business interest. And what that means is, let's say when you sell, you're selling the business, and that portion that you're transferring, that stock that you're transferring to a family member, let's say at sale, it'd be worth 10 million. But, when you're transferring it to a family member, the stock is going to be probably a minority amount of stock, probably is not going to have voting control, so we can take valuation discounts. And so even though upon sale, that stock may be worth 10 million, when we're transferring it for estate tax purposes prior to the sale, we're going to say maybe because of discounts, it's only worth 6 million, which is pretty valuable because then upon sale, that 4 million of gain from the sale is going to be in trust and outside of your taxable estate. And we just saved, a significant amount of estate tax. The other thing to think through too is, if you're worried, well, upon sale, I don't want to just gift all my stock away. Well, we can structure it in different ways. Sometimes we'll sell stock to a trust, for example, and in that way, upon sale, you're selling the stock for 6 million. The sale is for 10 million. At the sale, you'll get that 6 million back. But again, that 4 million is going to be removed from your estate and not subject to estate tax. So again, we can do some pretty valuable planning prior to a sale.
Great considerations, and it does seem counterintuitive at time that you want a lower value, but are there any final considerations for our audience to consider?
Sure, Brian. The biggest one that I see is, when we have a client who is thinking about a sale of a business or a significant asset, and they are charitably inclined, it's a good opportunity to grab a double tax benefit. Everybody knows that when you contribute something to charity, typically you're going to get an income tax deduction equal to the fair market value of that property. If you give appreciated securities or stock or real estate, you can also, before the sale, sufficiently before the sale, if you give that asset to charity, the gain actually is taxed to the charity. Good news, there's some exceptions, as corporations, but and sometimes depreciated real estate, but the good news is that gain is taxed to the charity. It's not taxed to you. You don't have to pick up the income tax. So in other words, you can get a tax deduction for the fair market value of your contribution, but then if you have significant appreciation, you don't have to pay income tax on that appreciation. That's the general idea of doing income pre-sale income tax planning. Secondarily, if you're interested in the concept that Stephanie was talking about, trying to save some estate tax, there's a way in which we could double up the bit by using that charitable gift in in collaboration or together with a combination with a gift to an individual. And when we do that, we can come out ahead. You can actually make a gift to charity, use that as a way to make a larger gift to your descendants or beneficiaries than you otherwise would be able to. That's called a charitable lead trust. Those have been very popular recently. So a lot of different things to think about there. But the other big one would be very neglectful to say, and we should hammer it in. These strategies require a little bit of forethought. If you wait to the date of sale, or we have some people call us up the day after they signed their letter of intent, or the day after they signed not a letter of intent, but a binding agreement. They call up and say, hey, can I do some income tax, or can I do some tax planning? That generally will not work. The IRS will say, nope, you have made your sale. It's binding. We're going to tax you on it, or we're going to say that the value of that company was what it is under the letter of intent or under the binding agreement. So it's really behooves everyone to think 2 or 3 years ahead in the best practice, right before you're going to go down the sale process, to consider strategies like this. And we can actually do, given enough time, we could do some enormous things with regard to mitigating tax. But very important, be proactive and take a look at these things on the sale process.
It sure sounds like, with as Stephanie mentioned, with the tax clock ticking, time. People need to move forward. So I want to thank you both for sharing your professional insights today and welcome you back. I also want to thank all of you for watching our presentation. For more information, please visit us on Foley.com under Family Offices. Thank you.